Most banks don't believe they have an engagement problem. They believe they have a utilization problem. The products are sound, the underwriting is disciplined, the communications are compliant, and still, customers don't move. Not because they don't want to, but because nothing they're being shown changes their financial reality. In banking, that's not a marketing signal. That's a risk signal. You invest in financial health tools, credit monitoring, educational alerts, digital nudges, and engagement plateaus, low single digits, quarter after quarter. At some point, the question stops being, how do we optimize this channel, and becomes, what assumption is holding this system in place? Most credit systems share a foundational assumption that the underlying credit data is accurate. Every score band, every decline reason, every pricing decision, they all inherit that belief. And when data moves at banking scale, errors don't self-correct. They persist quietly. The banks that see through the plateau do something different. They don't start with behavior. They don't start with marketing. They start with the data. They run a targeted scan across existing credit files inside their own environment using data they already govern. It takes minutes. What comes back reframes the problem. These customers aren't disengaged. They're misclassified. Accounts assumed to be fully priced for risk, applicants permanently declined, households written off as non-prime. They aren't. Their credit data is wrong, not one-off discrepancies, not fringe cases, material reporting errors at scale. That's when outcomes change. Not because a new product is launched, but because the institution can finally act on truth. You're no longer telling customers to monitor their credit. You're showing them this decision was influenced by incorrect data. There's a clear path to resolution, and here's how to take it responsibly. And customers respond immediately. Engagement doesn't improve because messaging gets louder. It improves because insights get sharper. Customers log in because the information is specific, because the issue is obvious, because the next step is clear and appropriate. This isn't a campaign effect, it's a trust effect. Then the business impact follows. Previously declined applicants re-enter eligibility. Risk is more accurately segmented. Existing customers re-engage without reacquisition costs. Cross-sell improves naturally. Loss exposure becomes more precise. And fair lending posture strengthens. Not through policy change, but through data correction. Most financial health tools explain outcomes after the fact. This identifies what distorted the outcome in the first place. Once you see that difference, it fundamentally changes how you think about credit. If you're responsible for growth, risk, or financial health, and engagement has stalled, reactivation is costly, or declines quietly disappear, this deserves a conversation. Not because it replaces your systems, but because it helps ensure they're deciding on accurate information. If that resonates, schedule a discovery call. We'll walk through what this looks like inside your bank environment, safely and at scale.